Welcome to the Modern Wealth Market Update, where we take a quick look at stocks, bonds, and the economy. I'm your host, Stephen Tuckwood, Director of Investments. Let's get going. In January, the US stock market built on the prior year's strong performance, with the S&P 500 rising by a very solid 2.8%. This monthly gain helped offset the recent losses experienced in December and sets a positive tone for the year ahead. Sector performance was diverse, with the communication services, healthcare, and financials doing most of the heavy lifting. Information technology, which is the largest of the 11 sectors, was the only negative sector for the month, declining by almost 3%. Interestingly, large-cap value stocks, which returned 4.6% for the month, was double that of the US large-cap growth stocks. In overseas markets, many countries outperformed the US despite a strong dollar. Brazil, Germany, and France were the standouts and reminded investors of the benefits of global diversification. After declining nearly 2% in December, bonds bounced back in January, with the Bloomberg US Aggregate Bond Index returning 0.53%. Both Treasury bonds and corporate bonds were generally in line with the broader index, but high-yield corporate bonds significantly outperformed, delivering 1.37% on the back of further tightening of credit spreads. Municipal bonds advanced for the month and nearly matched the broad Treasury market's return. Finally, in its meeting on January 29th, the Fed opted to maintain the federal funds rate at 4.25 to 4.5%, pausing the rate cuts initiated in September. They noted that economic activity continues to expand at a solid pace and that the labor market conditions remain strong, but inflation remains somewhat elevated. This decision reflects the Fed's cautious approach amid uncertainties including potential changes to fiscal policy, which include tariffs. That concludes your market update for January. If you have any questions, please reach out.